Turn everything off. Close every tab. Because the number I'm about to show you proves that the market you think exists does not actually exist anymore. $21. That's the spread between New York and Shanghai right now. New York is trading silver at $120. Shanghai is trading it at $130 an hour. Same metal, same day, $20 difference. And here's the part that should make your blood run cold. Nobody can close that gap. The arbitrage is dead. Ladies and gentlemen, the American guy here. It is Wednesday, January 29th, 2026. And I'm about to show you something that has never happened before. Not in 1980, not in 2011, never in modern market history. Silver just printed above $120 in Western markets. That's a record. That's unprecedented. But that's not the story. The story is Shanghai. The Shanghai Futures Exchange is showing silver at 30,191 yuan per kilogram. That converts to 138 to 25 per ounce. And it closed up 8.51% in a single session. Do the math with me. New York at $120. Shanghai at 139. That's a $19 to $20 spread, depending on which minute you check. And that spread isn't closing. It's widening. In a normal market, that doesn't happen. In a normal market, every hedge fund with a Bloomberg terminal would see that spread and attack it. Buy in the cheap market, sell in the expensive one, pocket the difference. Finance 101. The trade, every algorithm is programmed to execute automatically. Except nobody's executing it. The spread isn't closing. It's been sitting there for days, getting wider, mocking every trader who learned about efficient markets in business school. Why? Because you can't arbitrage what doesn't exist. The physical metal needed to close that gap isn't available. The supply chain isn't just slow, it's severed. And I have proof. Here's what happened in the last 48 hours. Perth Mint and Metalor, two of the largest silver refiners on the planet, stopped accepting new silver orders. Not delayed orders, not higher premium orders. Zero new orders. These aren't startups. Perth Mint opened its doors in 1899. They've been refining precious metals longer than airplanes have existed. Metalor started in 1852, the same year Uncle Tom's Cabin was published. These institutions have survived 2 world wars, the Great Depression, the end of the gold standard, and every market crash for over a century. And they just tapped out, said no, closed the order book. But it's not just them. Argor-Heraeus and Valcambi are reporting severe backlogs, with delivery dates pushed to April and May. We're in late January. That's a 3 to 4 month wait for refined silver from Europe's top facilities. And according to a statement released yesterday by BullionStar, one of Asia's premier dealers, they're actively sourcing whatever silver remains available in the market. Pause on that phrase. Actively sourcing. That's dealer speak for we're calling everyone we know, begging for inventory. A major bullion dealer, someone with Rolodexes full of refinery contacts and mining executives, just admitted publicly that they're hunting for supply like it is a treasure hunt. When was the last time you saw that? When was the last time multiple mints simultaneously stopped taking orders while dealers admitted they can't find metal? Never. This is not a logistics issue. This is not a temporary bottleneck. This is the physical supply chain snapping under the weight of demand that cannot be satisfied. And while the mints are shutting down, the premiums are exploding. BullionStar reported that wholesale premiums spiked 100% to 200% in 48 hours. That's not a squeeze. That's a repricing. The market is telling you that physical silver is worth double what it was 2 days ago. But the most terrifying part isn't the mints closing or the premiums doubling. It's what's happening in the vaults. Let me give you a number that should make every economist lose their mind. According to the Shanghai Futures Exchange daily report from January 29th, 2026, SHF silver vaults dropped 26,160 kilograms in one day. That's 26.36 metric tons. That's 847,000 ounces in 24 hours. To put that in perspective, the weekly SGE Silver Vault report from January 19th through 23rd showed a drawdown of 1,530 kilograms over 5 days. Yesterday alone, the vaults lost 17 times the weekly rate. This is not normal. This is not speculators trading paper contracts. This is physical metal being removed from the exchange system. This is manufacturers, sovereign buyers, or large institutions taking delivery and pulling silver out of circulation. And here's why that matters. When metal leaves the vault, it's gone. It's not coming back. If it's going into solar panels, those panels have a 25-year lifespan. That silver is locked up for a generation. If it's going into strategic reserves, it's not hitting the market again until a government decides to sell, which they won't do in a shortage. The vault drawdown is a 5% decline in total inventory overnight, in one session. Imagine if the comex lost 5% of its silver in a day. Imagine if 1 out of every 20 bars just vanished. That's what happened in Shanghai. And while Shanghai is bleeding inventory, New York is pretending everything is fine. The comex is still quoting $120 like the physical market isn't on fire, like the refiners didn't just quit, like the vaults aren't draining at 17 times the normal rate. This is the disconnect. This is the $21 gap. And it's telling you that the paper price in New York is a lie. Let me explain why the $21 spread isn't closing. Because this is the most important thing you need to understand about what's happening right now. In a functioning market, arbitrage works. Because the underlying asset is fungible and mobile. You can buy it in one place, move it, and sell it in another place. The profit from the spread covers the cost of moving it. But arbitrage only works if three conditions are met. First, the asset exists. Second, you can take possession of it. Third, you can transport it to where the price is higher. Right now, all three conditions are broken. The asset exists, technically, but you can't take possession because the refiners aren't delivering. Perth Mint isn't taking orders. Metalor isn't taking orders. Argor-Heraeus is quoting April delivery, which means the silver you buy today won't physically exist for 3 months. And even if you could take possession, you can't transport it fast enough. Shipping refined silver internationally takes weeks. By the time your metal lands in Shanghai, the spread might have widened, or the Chinese government might have imposed capital controls or export restrictions. So the arbitrage is dead. Not because traders don't want the free $21, but because the physical reality of moving metal has broken down. And when arbitrage dies, the two markets stop being connected. New York becomes a paper market where people trade contracts. Shanghai becomes a physical market where people trade actual metal. And the physical market sets the real price. That real price is $139, not $120. The $120 price is what you pay for a promise. The $139 price is what you pay for the metal. The gold signal. When both metals move together, it's not about metals. Now let me show you why this is bigger than just silver. Because while silver is doing its thing, gold is quietly doing something just as important. Gold on the Shanghai Futures Exchange closed at 1,249.12 yuan per gram. That converts to $5,490 per ounce, up 7.88% in one session. Do you see that? Gold and silver both surged on the same day. Gold up nearly 8%, silver up 8.5%. That's not a coincidence, that's not speculation, that's a coordinated move into hard assets. When both gold and silver surge with accelerating vault drawdowns and minting halts, the market is signaling something very specific. It's signaling a loss of confidence in fiat currency. This is not about industrial demand for silver. This is not about jewelry demand for gold. This is about people, institutions, governments looking at their currency and deciding they don't trust it anymore. So they're converting paper into metal as fast as they can. And China is leading the charge. The Chinese government has been accumulating gold for over a decade. But silver has quietly become strategic because of its role in solar panels, electronics, and defense technology. China controls a significant portion of global silver refining capacity. And they've tightened export controls on critical minerals, including certain silver compounds. When you see a government restricting exports while domestic prices surge 20% above international levels, that's not market inefficiency. That's strategic hoarding. China is locking down the metal they need for their energy transition and high-tech manufacturing. And they're willing to pay $139 to do it, while the West is still pricing it at $120. This is the macro backdrop. This is the reason the gap exists. China decided silver is strategic. And once a government decides something is strategic, price becomes irrelevant. Now let me talk about what could go wrong. Because anyone telling you silver can only go up from here is selling you something. And I'm not selling you anything except the truth. First, the CME can raise margin requirements. In 2011, when silver hit $49, the CME raised margins 5 times in 9 days. The rally collapsed. They can do it again. They already did it once this week. They can do it 5 more times. Second, Western central banks could intervene with coordinated swap lines or emergency leasing. If the Fed and the ECB decide to flood the market with leased silver from government stockpiles, they can temporarily suppress the price. Third, this could be a blow-off top. Parabolic moves often end in violent 50% corrections that wipe out everyone who bought in the last month. If you're buying at $120, you need to be mentally prepared for a drop to $60 or $70. Fourth, the Shanghai premium could narrow if Chinese authorities impose capital controls. If China decides to restrict domestic buyers from bidding up silver, the $139 price could drop back toward $120, and the arbitrage gap closes from the top instead of the bottom. Fifth, algorithmic trading could trigger systematic selling. If risk sentiment shifts, if the stock market crashes, if something else spooks the algos, they'll sell everything, including silver. And when algos sell, they don't care about fundamentals. They just dump. And sixth, we don't have full transparency into COMEX warehouse stocks or LBMA vault holdings. There could be off-market supplies that flood the market and crash the price. These are real risks. These are not hypotheticals. Every single one of these could happen. And if you're buying at all-time highs, you need to know your risk tolerance and have an exit plan. But here's why I think the bullish case just got stronger despite those risks. The Perth Mint and Metalor announcement isn't a logistics problem. These are century-old institutions. They've survived wars, depressions, currency collapses, and every market cycle for over 100 years. For both to simultaneously halt new orders means something structural broke. The 100% to 200% premium spike in 48 hours isn't temporary. Premiums don't double because of a short-term bottleneck. Premiums double because the market is repricing the asset. The 3 to 4 month wait for delivery from European refiners isn't normal. Silver is not a complicated product to refine. If Argor-Heraeus is quoting May delivery for orders placed in January, it means they don't have the raw material. The mines aren't producing enough. The recycling flow isn't sufficient. The supply is genuinely constrained. And the 26-ton vault drawdown in one day is the smoking gun. That's not speculation. That's physical offtake. That's someone taking 847,000 ounces off the market permanently. Here's the thing about mine supply. You can't just spin up a new silver mine in 6 months. Primary silver mines take 5 to 10 years from discovery to production. And most silver is produced as a byproduct of copper, lead, and zinc mining. So silver supply is inelastic. The price can go to $200, and it won't materially increase supply for years. Meanwhile, demand is accelerating. The Silver Institute's data shows industrial demand hit new records in 2024 and 2025, driven by solar panel production. China alone is installing solar capacity that requires hundreds of millions of ounces annually, and that silver doesn't come back. It's embedded in panels for 25 years. So you have inelastic supply and accelerating demand. That's the recipe for a supply crisis. And the $20 Shanghai premium is the market telling you the crisis is here. I can't predict the future, but I can map the possible roads. Road 1, the cliff. This is peak mania. We're at the blow-off top. Price implodes 40-50% over the next month. Everyone who bought above $100 panics. We spend 6 months crawling around $70 or $80 while the weak hands capitulate and the supply chain slowly heals. Then, maybe in late 2026 or 2027, we start climbing again. Road 2, the plateau. We've found equilibrium. Silver grinds sideways between $100 $130 for months. Refiners gradually restart operations. Chinese demand moderates. The Shanghai premium compresses to single digits. We trade in a choppy range until the next major catalyst breaks us out. Road 3, the breakaway. The crisis compounds. Refiners stay shuttered. Vault drawdowns accelerate. Shanghai premium explodes to $40, $50, $60. Physical becomes genuinely unobtainable at any reasonable price. Paper markets lose all credibility. We see $150, $200, potentially much higher as the system fractures completely. I have no crystal ball, but I know this. The risk-reward calculus just shifted hard. 6 months ago, buying silver at $30 meant risking 16% downside to potentially make 100% upside. Now buying at $120 means risking 30% downside to potentially make 50% upside if we hit 180. The risk-reward is worse at these levels. That's just math. For long-term holders who bought at $20, $30, $50, this is the moment you've been waiting for. But it's also the moment that tests your conviction. Do you take profits and lock in life-changing gains? Do you hold through the volatility? Do you take half off and let the rest run? There's no universal answer. You need to decide based on your situation. For new buyers, considering entering at $120, I'll be blunt. You're buying at all-time highs with limited downside protection. If you believe the supply deficit thesis, then dollar cost averaging over 3 to 6 months makes more sense than going all in today. Now, let me talk about the elephant in the room. If you own paper silver, ETFs, futures, unallocated accounts, you don't own silver, you own a promise. In dislocated markets where mints are halting orders and vaults are draining 5% in a day, the promise might not be worth the paper it's printed on. If Perth Mint isn't accepting new orders, what happens to existing unallocated certificate holders if they want to convert to physical? What happens when they call and say, I want my silver, and Perth says, we don't have it? The same applies to comex futures. In extreme circumstances, exchanges can declare force majeure and settle contracts in cash. It happened in the nickel market on the London Metal Exchange in 2022. It could happen in silver. I'm not saying it will. I'm saying it can. And you need to know that risk exists. When the physical market and the paper market decouple, when the spread is $21 and arbitrage is dead, the paper price becomes fiction. And if you're holding paper, you're holding fiction. Here's what you need to understand. The $21 spread between New York and Shanghai is not a number. It's a message. The message is the paper market is broken. The physical market is the only market that matters. And the physical market is saying silver is worth $139, not $120. When century-old refiners stop taking orders, when premiums double in 48 hours, when vaults drain 26 tons in a day, when dealers admit they're scrambling to find supply, the market is telling you something. It's telling you the supply is gone. It's telling you the price is wrong. It's telling you that the system is breaking. Whether that break leads to a collapse or a moonshot, we'll know in the coming weeks. But what's undeniable is that we're in uncharted territory. Silver just printed $120 in New York and $139 in Shanghai. The gap is 21. The arbitrage is dead. The mints are closed. The vaults are draining. And the market is screaming that the paper price is a lie. This is the American guy. It's Wednesday, January 29th, 2026. Silver hit $120 in New York, $139 in Shanghai. Perth Mint and Metalor stopped taking orders. Shanghai vaults lost 26 tons in one day. Premiums doubled in 48 hours. And the $21 spread is telling you everything you need to know. The physical market and the paper market have divorced. And in that divorce, the paper market gets the debt. The physical market gets the assets. Choose wisely. Like and subscribe, and share this with anyone who still thinks the comex price is real. Because 6 months from now, when the force majeure gets declared and the paper contracts get settled in cash, while physical silver trades at $200, they're going to wish they understood what the $21 gap was trying to tell them. The arbitrage is dead, the supply is gone, and the endgame is here. This is the American guy, signing off. Stay sharp and stay liquid.